In 2010, you could buy land in East Austin for $120 per square foot, cheaper than most investors dared to touch. Today, that same investment in the now legendary zip code 78702 could have transformed a $100,000 down payment into $1.7 million, a stunning return. But what precise set of events turned a forgotten quadrant into the epicenter of American real estate alpha? And what signals did Wall Street miss? The answer is buried in a timeline of contrarian bets, tech shockwaves, and irreversible shifts. So how did it really happen? In the aftermath of the financial crisis, the streets of East Austin told a story few investors wanted to read. Industrial lots sat idle and vacant parcels dotted the landscape. Yet, beneath the uncertainty, numbers quietly pointed to a different reality. In 2010, the average entry price for land in 78702 hovered at $120.08 per square foot, a price that by national standards looked like dead capital. Most institutional buyers ignored it, their attention fixed on more liquid markets or blue-chip equities. The S&P 500 had just posted a 15.06% return for the year, drawing capital back to Wall Street. In the following year, that same index would only manage a 2.11% gain, while the local real estate market in East Austin was beginning to decouple from national trends. For the risk-tolerant allocator, these numbers formed the basis of a compelling thesis. The entry cost, low by any urban metric, was not a sign of permanent stagnation, but rather the residue of a market still digesting the aftershocks of the crash. Regulatory ambiguity and a lack of clear development signals kept many at bay, but those willing to parse the data saw something else, a neighborhood mispriced relative to its future potential. The path of progress was shifting eastward, driven by population growth and the slow migration of creative and tech industries away from downtown's premium zones. The composite investor, operating with a disciplined capital allocation model, recognized that $100,000 could serve as a 20% down payment on a $500,000 asset, an asset that could be acquired at a fraction of replacement cost. The leverage multiplier embedded in this structure meant that even modest appreciation would produce returns far exceeding what was available in equities or bonds. While headlines described East Austin as a frontier for only the most speculative buyers, the underlying math told a different story. The conditions were set for a contrarian bet: buy undervalued land, capture the upside of urban infill, and let time and migration do the heavy lifting. This was not a play for the faint of heart, but for those who understood the difference between risk and uncertainty. 78702 offered an entry point that would soon become the envy of the country's most sophisticated allocators. On July 22, 2020, Tesla announced its decision to build a massive gigafactory on the southeastern edge of Austin. The news landed with immediate impact, sending ripples through the East Austin real estate market. Investors and speculators, already watching for signs of a tech-driven resurgence, now saw confirmation in the form of a $1 billion commitment and the promise of thousands of high-wage jobs. The effect was not limited to headlines. Within months, land deals accelerated, and the pace of residential permit filings in the 78702 zip code reached levels not seen in decades. By December of the same year, Oracle disclosed in an SEC filing that it would formally designate Austin as its corporate headquarters. Unlike traditional ground-up incentive packages, Oracle's move layered a headquarters designation onto an existing lakeside campus, reinforcing the city's status as a national tech destination. This binary event, two Fortune 500 giants anchoring their future growth in Austin, triggered a wave of capital migration into East Austin's urban core. Between 2010 and 2020, median household income in 78702 surged by 74.3%, the highest growth rate in the city. That demographic shift set the stage for what followed, a speculative apex during 2021 and 2022. Cranes became permanent fixtures on the skyline, and construction outpaced every previous cycle. Austin home prices, which had compounded at roughly 5% annually from the post-crisis trough through 2019, suddenly accelerated. In 2020, prices jumped 11% year over year. The following year, appreciation exploded to nearly 30%, with another 10% gain in 2022 before the first signs of cooling appeared. These years saw East Austin's housing market outpace even the S&P 500 total return, which reached 18% in 2020 and 28.7% in 2021. For investors who had entered the market a decade earlier, the effect was transformative. The combination of tech job creation, income growth, and relentless capital inflow compressed the time horizon for outsized returns. What had once been a contrarian bet on overlooked land became a textbook example of how binary events and demographic surges can violently reprice an entire urban corridor. $100,000 down payment in East Austin in 2010 was not just an entry ticket, it was the ignition point for a leverage engine that rewrote the rules of urban capital allocation. With a standard 20% down, the investor controlled a $500,000 asset at a time when the prevailing price per square foot hovered near $120.08 per square foot. The remaining $400,000 was financed, locking in a 30-year fixed mortgage at rates typical of the post-crisis era. Over the next 15 years, appreciation did the heavy lifting. By 2025, the average unit price in zip code 78702 reached $527 per square foot, a 4.39 times increase from the original basis. The median home price climbed to $690,000, with recent month-over-month data showing a rise to $699,000. Even the broader neighborhood average, at $560,372, dwarfed the original acquisition cost. This is where leverage multiplies the outcome. The asset's value rose by more than 339%, but the equity position grew far faster. As the mortgage amortized, the principal balance shrank, while the property's market value compounded each year. By 2025, the remaining loan balance on the original $400,000 mortgage stood near $299,000. Subtracting debt from market value, the investor's equity ballooned to nearly $1.7 million before transaction costs or taxes. The return on initial equity, measured as a multiple of the original $100,000 outlay, landed at 1,694%. This was not a function of luck or isolated market timing, but the mechanical result of pairing moderate leverage with sustained above-trend appreciation. The balance sheet transformation was stark. A single contrarian allocation, amplified by debt, converted a six-figure commitment into generational wealth. Every line item, including purchase price, loan terms, and market value, can be traced through the spreadsheet. The story of zip code 78702 is not just one of rising prices, but of how leverage, deployed at the right moment, can turn overlooked neighborhoods into engines of capital compounding. Rental income in East Austin's 78702 zip code delivered more than just appreciation on paper. For investors holding well-located properties, short-term rentals generated revenue of $50,786 at peak, with utilization rates near 64%, translating to roughly two-thirds of the year booked. That level of performance, while not the median across the city, was achievable for top quartile listings, especially those positioned near downtown and event corridors. Gross rental yields reached 6.47%, a figure that often covered mortgage payments and a portion of rising operational expenses. But the math behind holding these assets was never static. Property taxes in Travis County climbed 8% over the holding period, with the current tax rate standing at 1.63%. In 2025, a targeted hike added maintenance costs of $24.73 for maintenance and operations, a cost that ate directly into net returns. As the market matured, long-term rental income in the metro area found its ceiling at $1,950 per month, but many landlords saw seasonal dips, with average rents dropping to $1,524 during weaker periods. The gap between top-line revenue and net cash flow widened as insurance premiums and regulatory pressures increased, especially for short-term rental operators navigating new city ordinances and saturation risks. Yield was only part of the equation. The ability to carry these properties through volatile cycles depended on more than rental income. The value floor in 78702 hit $606,863 before a modest rebound, and the area weathered a correction of negative 18.11% during recent market turbulence. Inventory sentiment hovered at $687,500, even as alternative investment options outside real estate offered annual returns of 25.02%. In 2025, equity performance in the zip code settled at 16.63%. Still strong, but no longer the runaway outlier of previous years. For the disciplined allocator, the headline numbers of the last decade are now tempered by carry drag, tax friction, and the binary risk of corporate departures. Oracle's 2024 expansion into Nashville introduced a new element of uncertainty, diluting the unique tech halo that once defined Austin's east side. The story of 78702 is no longer just about how much can be gained. but how quickly those gains can be eroded by shifting economics and policy. The era of effortless alpha has given way to a market where every line item matters, and where historical returns are no guarantee of future performance. Today, capital still hunts for the next 78702 zip code, but the era of effortless alpha is gone. Policy risk and shifting corporate bets shape every market's future. Only one thing is certain: timing and context matter more than ever.